Modern portfolio theory relies on a number of assumptions on investor behavior. These assumptions are based on research from psychology and other fields describing how investors view uncertainty. So here's a list of the important assumptions underlying portfolio theory. The first two assumptions are quite straightforward. They say that investors prefer more wealth to less wealth, and they prefer less risk to more risk. The third assumption says that as we get more wealthy, the happiness that we derive from each additional unit of wealth declines. The fourth assumption can be understood as follows. Suppose we are at $100 and our wealth increases from 100 to 110. We experience an increase in happiness. However, this increase in happiness is less than the decrease in happiness that we experience when our wealth declines from $100 to $90. Thus, there is an asymmetry in how we view an increase in wealth versus an decrease in wealth. The fifth assumption can be understood with this simple example. Suppose I give you two deals. Deal one provides you with $100 for certain next month. Deal two provides you with $110 with a 50% probability and $90 with a 50% probability next month. So the expected value of deal two is $100. In this case, most of us or all of us would prefer deal one to deal two. That is, we prefer a certain outcome over an uncertain outcome of equal value. The next assumption says that we may be indifferent between assets with different payoffs of risk and return, just as we are indifferent between having a bagel or a donut for breakfast. So we may prefer a high risk, high return asset just as much as a low risk, low return asset, which leads us to the idea of indifference curves. And then finally, the last assumption says that we are more tolerant to risk as we become more wealthy. Let's consider a simple world where we have only two asset classes, a risky asset comprised of the S&P 500 index and a risk-free asset comprised of the US Treasury bill. The portfolio allocation problem requires you to allocate your wealth, say $100,000, between these two asset classes. Graphically, the portfolio allocation problem can be solved as follows in the mean variance framework. So you have the y-axis where you have expected returns, and you have the x-axis where you have the standard deviation. The risk-free asset has a zero standard deviation and therefore would lie on the y-axis, and the risky asset, which is the market portfolio or the S&P 500 index, is at this point here. And so the possible set of allocations would lie on this line, which is the capital allocation line. And on this capital allocation line, we will superimpose the utility function. And utility function may look something like this. And the utility function intersects on these points, say A and B. And the investor would realize a certain level of utility in this indifference curve. But if we push this utility function further out, we observe an increase in utility for the investor. And so points C and D would be preferred over points A and B. And if we push this out even more, we might have this indifference curve. However, this indifference curve does not intersect the capital allocation line, so we have to move a little bit in this direction. And so that leads us to this particular indifference curve, which is just tangent to the capital allocation line. And this point here describes the optimal allocation for this investor. This slide presents an algebraic representation of the investor's optimization problem in a world with one risky and one risk-free asset. The investor's objective is to maximize their utility or happiness subject to the available investment opportunities. The utility function is a simple representation here wherein the investor prefers more return to less return and prefers less risk to more risk. And the scaling factor here is represented by the coefficient on risk aversion A, which picks up the risk profile of the investor. The investment opportunity set is the capital allocation line, represented here by the expected return and the variance function. To solve the optimization problem, one would set up the Lagrangian multiplier and differentiate with respect to the choice variable, which in this case would be y, the percentage allocated to the risky asset, and set up the first order condition, equate it to 0, and then when you solve, you would get an expression for y star, which is represented here. Let us focus on the economic interpretations of Y star, which is the percentage of the portfolio invested in the risky asset, the S&P 500. So, for example, if the Y star is 0.5, then it means that 50% of our wealth will be in the S&P 500, and 50% of our wealth will be in the risk-free asset. So the numerator of Y star is the risk premium, which means that if we expect the S&P 500 to outperform the treasury bill by a larger amount over the next 12 months, then today we will invest a higher percentage of our wealth in the S&P 500. The denominator of the Y star equation has the volatility of the S&P 500, or our forecast of volatility. And if we expect the risky asset to have a higher volatility, there is more uncertainty, then we would reduce our investment in the risky asset by reducing the Y star. And then finally, you have the coefficient of risk aversion A, and this tells us that holding risk premium and volatility of the risky portfolio constant, if someone has a higher degree of risk aversion, that is, they cannot tolerate risk, then they would invest less in the risky asset. So this is a very simple derivation, but as you can see, it's very intuitive, and it's consistent with a logical way of thinking about portfolio allocation.